Have you ever wondered how the world's most successful investors strike the perfect balance between risk and reward? Well, you're in luck. Because today, we'll reveal the secrets that you can use to achieve the same success in the world of investing. Hi, and welcome back to Money Matters, your trusted, all-inclusive channel for making finance easy and covering everything you should know about making your money work for you. Today, we're going to dive into the concept of risk and reward in investing. We'll explore how to master the delicate balance between these two critical elements to maximize your profits. Whether you're a seasoned investor or just starting out, understanding the relationship between risk and reward is essential for successful investing. So if you're ready to take your investing game to the next level, stick around as we unravel the secrets of risk and reward. But before we dive into it, if you're new here, don't forget to hit that subscribe button and ring the bell to stay updated with all our latest content. And if you find this video helpful, be sure to give it a thumbs up. Also, don't forget to share this video with someone who also could benefit from this info, so they stay updated as well. Now let's get started. Understanding risk and reward in investing. In the world of investing, risk and reward are two sides of the same coin. They are intertwined, and you can't have one without the other. But what exactly do we mean by risk and reward? Risk, in investing terms, refers to the potential loss that an investment may incur. It's the possibility that the actual return on an investment may be different from its expected return. This could mean losing part or all of the money you've invested. On the other hand, reward is the potential gain you stand to make from an investment. It's the return you expect to earn for taking on a certain level of risk. The key to successful investing lies in understanding this risk-reward trade-off. It's about finding the sweet spot where the potential reward justifies the risk you're taking. Now, take a moment to reflect on your own investments. Are you comfortable with the level of risk you're taking for the potential rewards? If you're not sure, keep watching, because next up we'll dive into understanding your risk tolerance. Understanding risk tolerance. Understanding your risk tolerance is a crucial part of investing. It's about knowing how much risk you are comfortable with and how much you can afford to lose. It's about balancing your desire for returns with your ability to sleep at night. There are several factors that can affect your risk tolerance. These include your financial situation, your investment goals, your age, and your personal comfort with risk. For example, if you're young and have a stable income, you might be able to tolerate more risk because you have more time to recover from any potential losses. On the other hand, if you're nearing retirement, you might prefer safer investments to protect your nest egg. It's also important to consider your emotional tolerance for risk. Some people are naturally more risk-averse than others. If the thought of losing money keeps you up at night, it might be a sign that you have a low risk tolerance. Remember, there's no right or wrong level of risk tolerance. It's a personal decision that should be based on your individual circumstances and comfort level. Take a moment to reflect on your own risk tolerance. Are you comfortable with taking on more risk for the potential of higher returns? Or would you prefer to play it safe and potentially earn less? Or maybe you're unsure what risks you're even faced with. No need to worry though. We'll cover that one next. Types of investment risks. Let's delve deeper into the types of risks involved in investing. Investing is not a one-size-fits-all game. Different investments come with different types of risks. First, we have the market risk. This is the risk that the entire market will decline, affecting almost all investments. It's like a storm that doesn't spare any ship in the sea. Next, we have credit risk. This is the risk that the company or government entity that issued a bond will run into financial difficulties and won't be able to pay the interest or repay the principal at maturity. It's like lending money to a friend who suddenly loses their job and can't pay you back. Then there's liquidity risk. This is the risk that you won't be able to sell your investment when you want to, or you'll have to sell it at a price lower than its true value. It's like trying to sell a house quickly in a slow real estate market. These are just a few examples. There are many other types of risks like inflation risk, interest rate risk, and so on. The key is to understand these risks and find ways to manage them effectively. Now, take a moment to reflect. What types of risks are you exposed to in your current investments? And how can you manage them better? Maybe you're thinking, okay, I know what my risks are, which is neat, but how do I know how big they are? Once again, you're in luck, because exactly that is our next topic. Measuring investment risk. In the world of investing, understanding risk is only half the battle. The other half is being able to measure it. But how do we do that? Well, there are several ways to measure investment risk. One of the most common methods is using a statistical measure called standard deviation. This measures the amount of variability or dispersion around an average. In investing, standard deviation is used to gauge the amount of expected volatility. A high standard deviation means the price of an investment can move significantly in either direction, while a low standard deviation means the price is more stable. To apply this, you can use financial software or online platforms that provide standard deviation values for different investments. Another useful measure is beta. Beta measures the sensitivity of an investment's returns to the returns of the market as a whole. A beta of 1 indicates that the investment's price will move with the market, while a beta less than 1 means the investment will be less volatile than the market. A beta greater than 1 indicates the investment's price will be more volatile than the market. To use beta, you can compare the beta of your investment to the market, usually a beta of 1. If your investment has a beta higher than 1, it means it's more volatile than the market. Lastly, we have the Sharpe ratio. This measures the performance of an investment compared to understanding investment rewards. When it comes to investing, the rewards are the returns you gain from your investments. These returns can come in various forms, such as capital gains. This is the increase in the value of your investment. For example, if you buy a stock at $10 and it increases to $15, your capital gain is $5. Dividends. These are payments made by a corporation to its shareholders, usually in the form of cash or additional shares. Not all stocks pay dividends, but those that do can provide a steady stream of income. Interest. This is the money you earn from keeping your money in a bank account, bond, or other interest-earning investment. The interest rate is usually set when you make the investment, and you'll receive the interest after a certain period of time. Rental income. If you invest in real estate and rent out your properties, the rent you collect is a form of investment reward. Remember, the potential for higher rewards comes with a higher level of risk. It's important to balance the potential rewards of an investment with the risks involved. Now, let's think about it. What kind of rewards are you aiming for in your investment journey? Are you more interested in capital gains, or are you looking for a steady income through dividends or interest? Understanding your investment goals can help you choose the right investments. Next, we'll talk about some strategies to balance risk and reward in your investment portfolio. Balancing risk and reward. Balancing risk and reward is a crucial aspect of successful investing. It involves understanding your risk tolerance and creating a diversified portfolio that aligns with your investment goals and risk tolerance. One of the primary strategies for balancing risk and reward is diversification. This involves spreading your investments across various asset classes, including stocks, bonds, and alternative investments. Diversification can help reduce the potential for significant losses, as the poor performance of one investment can be offset by the good performance of another. Another strategy is rebalancing. This involves periodically reviewing your portfolio and making necessary adjustments to maintain your desired asset allocation. For instance, if one type of investment has done well and now makes up a larger portion of your portfolio than you intended, you might sell some of it and use that money to buy more of other types of investments to get your portfolio back to your desired allocation. Remember, the key to building the right investment portfolio is to balance risk and rewards. Planning for your financial future is vital, and investing plays a critical role in building your nest egg. Now, take a moment to reflect on your current investment strategy. Are you effectively balancing risk and reward? What steps could you take to improve your strategy? All right, let's make things interesting. We'll provide a real-world example of an investment scenario where risk and reward were successfully balanced for maximum profit. Case study: balancing risk and reward in real-world investing. Let's take a look at a real-world example of how balancing risk and reward can lead to successful investing outcomes. Consider the strategy of a balanced investment. This is a portfolio allocation and management method aimed at balancing risk and return. Such portfolios are generally divided equally between equities and fixed income securities. For instance, an investor might have 50% of their portfolio in stocks to pursue growth, and the other 50% in bonds to provide income and stability. This balance allows the investor to participate in the potential upside of the stock market while also having a safety net during market downturns. During a bull market, which is a market condition where prices are rising or are expected to rise, the stocks in the portfolio may perform exceptionally well, providing substantial returns. However, during a bear market, which is a condition where prices are falling or expected to fall, the bonds in the portfolio can help cushion the blow of falling stock prices. This balanced approach to investing demonstrates how an investor can manage risk while still pursuing a rewarding return on investment. It's a practical example of the principles we've discussed in this video. Now, think about your own investment strategy. How well is it balanced to handle the ups and downs of the market? So you don't feel left out, we'll provide some practical tips on how you can manage investment risks next. Risk management strategies. These include avoidance, retention, sharing, transferring, and loss prevention and reduction. Stay informed. Keep up to date with market trends and news. Knowledge is power, and the more you know about your investments and the markets, the better you can manage your investment risks. Remember, investing always involves risks, but with careful planning and management, you can aim to make the most of your investments while keeping potential downsides in check. Now take a moment to reflect on your own investment strategy. Are you diversifying your portfolio? Are you aware of your risk tolerance? How are you managing your investment risks? In the next section, we'll wrap up everything we've discussed in this video. Risk management strategies. These include avoidance, retention, sharing, transferring, and loss prevention and reduction. Stay informed. Keep up to date with market trends and news. Knowledge is power, and the more you know about your investments and the markets, the better you can manage your investment risks. Remember, investing always involves risks, but with careful planning and management, you can aim to make the most of your investments while keeping potential downsides in check. Now take a moment to reflect on your own conclusion. And there you have it, folks. We've taken a deep dive into the world of risk and reward in investing. We've explored the different types of risks, how to measure them, and the potential rewards of investing. We've also discussed strategies for balancing risk and reward, and looked at a real-world example of how this balance can lead to maximum profit. Remember, investing is not a one-size-fits-all game. It's about understanding your own risk tolerance, setting clear investment goals, and making informed decisions. And while the risk is an inherent part of investing, with the right strategies and a balanced approach, you can navigate the market's ups and downs and come out on top. As we wrap up, we hope you found this video on risk and reward helpful. If you did, think about someone who might also benefit from this info. As you see, financial knowledge is of critical importance, especially in today's world. After all, we don't have our name for nothing. Money does matter. If you got someone, share it with them so they don't miss out. We'd love to hear your thoughts, so feel free to leave a comment below. If there's any topics you'd like to know more about, be sure to drop them in the comments. Your feedback helps us create content that serves your needs. Don't forget to like, comment, and subscribe to stay updated with all our latest videos. We have a lot more informative and exciting content planned for you, and that's all for today. Thank you for watching and investing your time with us. We hope to see you again next week here at Money Matters, because your money matters.